Let's Talk Accounting answers the question, what is? Removing the jargon of accounting, finance, and business. Shedding light on some of the jargon used, clarifying the jargon into everyday words you'll understand, and get a clearer view of what is happening in your world, building your confidence in the world of business. Let's get started. Next. Number 59, what is marginal tax rate? A margin tax rate is the amount of additional tax paid for every dollar earned as income. A 10% tax rate means 10 cents of every next dollar earned would be taken as tax. The average tax rate is the total tax paid divided by the total income earned. Next. Number 60, what is mark-to-market? Mark-to-market, MTM, is an accounting practice involving adjusting the value of an asset to reflect the current market conditions. For example, in the stock market, prices move up and down. As a result, a rise means positive MTM, and a fall means negative MTM. At the end of the fiscal year, a company's balance sheet must reflect the current market value of certain accounts. Next. Number 61, what is market capitalization? Market capitalization is the total dollar market value of a company's outstanding share of stock. Referred to as market cap, calculated by multiplying the total number of shares by the current market price of one share. Also, it can be used to compare the size of one company to another. Market cap measures what a company is worth on the open market, because it reflects what investors are willing to pay for its stock. Next. Number 62, what is market value? Market value is the most probable price an asset should bring in a competitive and open market under all conditions to a fair sale. The price a buyer is willing to pay for something. Next. Number 63, what is monetary policy? Monetary policy is a central bank's actions and communications that manage the money supply. Central banks use monetary policy to prevent inflation, reduce unemployment, and promote long-term interest rates in order to maintain price stability and achieve high economic growth. Next. Number 64, what is money supply? Money supply is the total stock of money circulating in an economy. In simple terms, it is the currency in circulation plus deposits in commercial banks. Consisting of total currency circulating in the public plus the non-bank deposits with a commercial bank. An increase in the supply of money typically lowers interest rates, stimulating spending. Next. Number 65, what is a mortgage? It's a type of loan, debt, you can use to buy or refinance a home. Also referred to as mortgage loans. A mortgage is a way to buy a home without having all the cash up front. The principal is the amount borrowed from the lender to buy the property. The interest is the cost of borrowing the money. Next. Number 66, what is negative gearing? It's a means of borrowing to invest. When you take an investment loan, your property is geared. Negative gearing happens when the cost of owning a rental property exceed the rent returns you earn. The rental loss can be offset against other income earned, such as your salary, reducing your taxable income and how much tax you have to pay. Next. Number 67, what is net asset backing? It's the total value of all the assets a company has minus any liabilities, divided by the number of shares issued. Representing the funds per share of market value. Telling us how much one share of the company is worth. A negative net asset backing implies the falling performance of a fund. A positive net asset backing implies the increased performance of a fund. Next. Number 68, what is operating profit/loss? It is used to investigate the profit-making potential of a business. To determine operating profit, operating expenses are subtracted from the gross profit. It is a key number for managers to watch, as it reflects the revenue and expenses that they can control. An operating loss occurs when core business income ends up being lower than expenses. An operating profit occurs when core business income ends up being higher than expenses. Next. Number 69, how to increase your profit margin. 1. Avoid markdowns by improving inventory visibility. 2. Elevate your brand and increase the perceived value of your products. 3. Streamline your operations and reduce operating expenses. 4. Increase the average order value. 5. Implement saving in the purchasing practices. 6. Increase your prices. Next. Number 70. What is paid-up capital? Paid-up capital is the amount of money a company has received from shareholders in exchange for shares of stock. By selling its shares on the primary market direct to investors, usually through an initial public offering (IPO). Paid-up capital is important because it's capital that is not borrowed.
If you don't know what you're doing, it's a jungle out there.
This completes the chapter. Watch this space for the next chapter of Let's Talk Accounting.